Thank you, Tom. I appreciate it. Thank you for inviting me. It's always good to speak to you and your members, so I appreciate it. Okay, share my screen. Audience view. Okay. All right, is my screen up? It is up. Okay, thank you very much. That went smoothly. I appreciate that. Welcome. I'm Dan Rahill. I'm Managing Director with Wintrust Family Office Banking Practice, and JP and Hills and I lead that practice here at Wintrust, and we work closely with Tom, as you know. Let's talk about the tax provisions in the CARES Act first. Trying, not that this is any more important than any other provision, but we wanted to present it first and talk about, let me close my box here. I'm sorry, it went back to me. Okay, here we go. Let's talk about something that's gotten a lot of press and may not apply to everyone that's on the phone or on the webinar right now, but cash payments from the Treasury. If this doesn't apply to you, if you're over the limit where it phases out, it may apply to one of your kids, one of your neighbors, one of your friends. I myself got a call this morning from a son of mine who's at MBA school asking where's my check because all my friends at school have gotten theirs. And I had to explain to him how the phase out works and the fact that he mailed in a paper return just a few weeks ago, and the IRS last week stopped processing paper returns, so they probably have not processed his 2019 return yet, and his 2018 return was over the limit. So let's talk a little bit about this so you're prepared for those cocktail conversations that you have later today on Zoom when people start asking about this. Individuals that file singly get $1,200 credit and $2,400 for joint filers. Many of the checks went out in the last 2 days, as you'll read. In addition, you should get $500 per qualifying child. I read this morning that there's been a lot of mix-ups on that. People will get their $1,200 or $2,400 checks, but missing the children, they will work out the details. This has been quite rushed, as you can imagine. The phase-out for individuals at AGI, if your AGI is over $75,000, it completely phases out at $99,000, and for married filing jointly, the phase-out starts at $150,000 and completely phases out if you have no children at $198,000. So that's a little bit on what's getting all the press these days. Let's talk about taxes for a minute. And can I take a charitable contribution if I don't itemize? As you probably know, 90% of taxpayers do not itemize as a result of the Tax Cuts and Jobs Act at the end of 2017, effective in 2018. This act, the CARES Act, now allows people that do not itemize a $300 above the line, we tax people call it, above the line deduction against adjusted gross income. And there's a few strings attached that are listed here. It must be made in cash, and it must be to obviously publicly supported charities, but it does not apply to not operating private foundations or donors advised funds. If you do itemize, what are the rules for charitable contributions? Well, previously the rule was you can deduct up to 60% of your adjusted gross income, and excess contributions would carry forward 5 years. The CARES Act suspended that 60% limitation, so now you can deduct all the way up to AGI in the current year, in 2020, charitable contributions, and effectively eliminate your income. Now, this would require some computations. I've been giving this some thought. You may not want to completely wipe out and offset your adjusted gross income, because then you would lose the benefit of your itemized deduction. So it probably would be in the neighborhood of maybe 90% of AGI would you get you the best result. And again, excess contributions will carry forward 5 years. You cannot use your donor advised fund or private foundations, unfortunately, to do this. Corporations. Many of my clients and friends make contributions to their corporations. What are the rules on that? Well, before the CARES Act, it was 10% of taxable income limitation, and now that's been increased to 25%. In addition, contributions of food inventory has increased from 15 to 25%. Now, people ask me what do I think one of the biggest benefits of the CARES Act is for both individuals and corporations, and I have been in the minority in a lot of situations because I've said it's the NOL provisions. And let me explain why I think that if it works and applies for either a corporation or an individual, and remember it does apply to individuals as well. Previously, NOLs could only be carried forward. You could not carry back an NOL. In addition, a net operating loss was limited to 80% of taxable income without regard to the NOL deduction. What the CARES Act has done, it permits individuals and corporations with NOLs to carry them back 5 taxable years to years that you did have income. You could carry back the losses, free up the tax, and receive a cash tax refund. There are forms that provide quickie tax refunds that they have to provide the refund in a certain number of days, 45 days, from when you file the form. I think this is very big for corporations and individuals that incur losses in 2020, and believe me, there are going to be a lot of them, and there's going to be a lot of carryback under this provision. It's not being talked about that much yet. You'll see it at the end of the year when people start carrying back their losses for 2020. Also, there's a rate play here that I want to mention, and that is that when you carry back from a current year, let's use a corporation for example, you're carrying back from what is taxed today at a 21% tax rate to years where you paid 35% federal income tax in the highest bracket. That's very important. You're taking deductions that would have been taxed at 21 and you're freeing up income, getting taxed back at a 35% tax rate. So there's a great rate arbitrage there that I think is a very, very important aspect of this. Qualified improvement property. Why do I mention this? You'll see this mentioned everywhere, and people don't really understand what qualified improvement property is or why this is in the Act. There was a mistake, an error, and it's been freely admitted by Congress in the Tax Cuts and Jobs Act at the end of 2017. And starting in 2018, interior improvements of buildings that are non-residential, so residential property is excluded, but business buildings could not be take bonus depreciation. You're not eligible for bonus depreciation, and those leasehold improvements were depreciated over 39 years. The Act has changed that. It's a technical correction. For qualified improvement property in 2018 or 2019, you now can claim bonus depreciation. What does that mean? Well, that means that now you can take 100% deduction on what you put in service in those years, on those improvements, and now carry them back as a loss. What did I just say? Net operating losses can carry back 5 years now. You can carry those losses back and free up tax at a 35% tax rate, whereas in 2020, 2019, 2018, you're paying tax at a 21% tax rate. I think that is a really big deal. Again, more to come on that when you see that when people start filing those quickie refund returns and carrying back their NOLs. Excess business losses. I don't see this often, but I have seen it. I've seen individuals with particular business losses in excess of $500,000. And the Tax Cuts and Jobs Act limited those losses to $500,000, with the excess being carried forward as an NOL. What has changed under the CARES Act? It suspended that rule that came into play in 2018. So in 2018, 2019, and 2020, there is no limitation on these losses. So if you filed a return in 2018 or 2019 to date, or you will, you can now deduct a full loss in excess of $500,000. And if you end up in a net operating loss position, you can carry that back and free up prior year's tax. Again, that's why this one is important. It ties into NOLs. How do I take advantage of it? As I just said, you can, if you've not filed in 2019, you can take the full loss and carry it back. Interest expense deductions, again, another benefit of the CARES Act. Previously, there was a 30% limitation on interest expense that you could deduct on your tax return. That has now been increased to 50% for this year. What type of expense are companies going to incur this year in 2020 in excess of what they've typically incurred in the past. It's interest expense because of increased borrowing to stay afloat. That's why this is important. You can now deduct more interest expense off your tax return. Student loans, again, this affects my son who called this morning, who has student loans. The CARES Act suspends payment on federal student loans for 6 months and waives any interest on those loans as well. Those missed payments will be treated just as if they've been paid for purposes of loan forgiveness. In addition, there's other financial aid aspects of the Act, especially if you have to withdraw from school shut down, but these provisions do not apply to private loans. Again, this is a situation where employers can reimburse that I've had in my own family. My son, when he was a manager at one of the big 4 accounting firms before going back to grad school, received reimbursement up to $5,250, which is a number that's in the Internal Revenue Code. That's why it's a unique number, and it's previously been in the code for years. But an employer can reimburse an employee up to $5,250 towards reimbursement of towards payment of their student loans, or in addition to new student loan or tuition fees and books that they incur. Again, promoting them to go back to school or paying their student loans. That is now forgiven. If an employer does pay that now, it's non-taxable to the student, where before it was. So let's jump ahead to some of the loan programs that have been receiving all the press, as you've seen. The Payroll Protection Program, this has been the most talked about program over the last few weeks. What is it? It is an SBA, a Small Business Administration loan program designed to provide capital to cover the cost of retaining employees. Again, Payroll Protection Program. It's for retaining the employees. Now, they put a cap on the number of employees of 500, but there are several exceptions to the 500 employee rules, and it gets very complicated, and a series of Q&As have come out from both Treasury and SBA defining how do you count these employees. I'm close. How do I count them? If anybody has any questions on that, and again, this is evolving, please feel free to reach out to me. My contact information is at the end of these slides. So let's just say, what is the key aspect? That you get a loan, and the aspects I'll show on the next slide. You get a loan, that's great, at very favorable conditions. Well, guess what? Over the 8-week period, starting the date that you take out the loan may be forgiven. Tax-free, a tax-free forgiveness provision in this, and that's why this is so important. Who's eligible for the program? Any small business concern, nonprofits, and I have an asterisk here at the bottom of the slide on what constitutes how a nonprofit is designed, veterans organizations, etc., as well as sole proprietors, 1099 contractors, and self-employed individuals. They also qualify for this program. You must have, as I said, fewer than 500 employees. It includes full-time, part-time, or other employees, and it must meet SBA standards. Again, this is an SBA program. The SBA has very complex rules on size standards, or you must have less than 15 million of tangible net worth and less than 5 million of average net income in the last 2 years. If you have that, then you don't need to worry about the 500 employee rule. There are affiliation rules. As I said, this is not an easy calculation to determine how many employees you have. Affiliation rules. So if you are part of a controlled group, if you have part of a group that has common control of another entity, you very well would have to aggregate those employees in coming up with your 500 number. So you may not qualify, whereas otherwise you would think. Now, there are additional exceptions for the hospitality and dining industries for hotels and restaurants. So a hotel chain, a national hotel chain, obviously has more than 500 employees. The exception is for those industries that are based on SBA codes, so determining what their industry code is, they can look and see, oh yeah, I qualify for this under the SBA rules, and it's a location by location basis. So it would be in an individual hotel that has less than 500 people, not the whole organization. An individual restaurant with less than 500 employees, not a restaurant chain. So those will qualify. Those are, again, more exceptions to the rules. Who's not eligible for the program? Banks, life insurance companies, anybody located in a foreign country, illegal businesses such as cannabis businesses, private clubs and businesses. That's a question I've got. Can my country club qualify for payroll protection program? We have less than 500 employees. Unfortunately, private clubs and businesses that limit memberships for reasons other than capacity cannot take the loan. How do you apply? Well, you have to apply through an SBA approved bank or financial institutions. Even some fintechs are getting into the game now. They have to be approved. So documentations requirements will vary between the institutions, but generally, and here's a rule, the very first bullet point that came out just in the middle of this week, for self-employed individuals, you have to attach your Form 1040 Schedule C. So your profit and loss statement from your self-employed business with the application. Other examples include tax returns, year-end financials, year-to-date financials, and a spreadsheet including all of your payroll costs, looking back a year for measurement purposes, and also spreadsheets or other documentation of rent, mortgage interest, and utility costs. How much can you borrow? That's the key question here. How much? It's a loan up to $10 million or the lesser of, or 2.5 times the average monthly payroll costs. 2.5 times the average monthly payroll costs. Well, how do you compute that? And we'll talk about that in a minute. Looking back a year, most companies look at the average monthly payroll costs at calendar year 2019. This is explained in the Q&As that have come out from Treasury. You can, most likely, there's several alternative methods, by the way, but most likely you'll look at calendar year 2019 and then look at what your average monthly payroll costs are now. What are the terms of the loans? The loan may not exceed 4%. So the interest rate is going to be 4%. The interest rate may not exceed 4%, but Treasury has come out and said, and SBA has said, the interest rate will be 1%. Will be 1%, up from 0.5%, and the loan term will be for 2 years. It could have been up to 10. It will be for 2. These are further clarifications that have come out since the act was passed. There will be no application fee. There's no requirement that the applicant was unable to obtain credit elsewhere. There's no personal guarantee required. Payment deferral is deferred. Payment is deferred at least for 6 months, and you're not prohibited from receiving another loan called the EIDL loan, which I'll talk about right after this. So you can be eligible for both types of loan. You just can't use the proceeds for the same purpose. I'll get into that in a minute and explain what that means. No prepayment penalty if you decide to prepay the 2-year loan early. And when computing the payroll costs, you only include compensation up to $100,000 per employee. That has been an issue. That's probably one of the most asked questions in the last 2 weeks. How do you compute the $100,000? Does it include benefits? Does it not include benefits? Does it include taxes? Does it not include taxes? And the advice we've gotten from Treasury and SBA is that it's gross income on the per employee, and the $100,000 limit is on cash payment to the employee, and you get to add insurance benefits and other pension benefits on top of that $100,000 when computing that number. And that's important because it increases the amount of your loan. Loan forgiveness. As I said, this is one of the most important provisions in this act and why we've been talking about it. The loan can be forgiven, tax-free. It's free money. So you need to meet those certain provisions that are here. And again, this gets very complex and has been the source of a lot of questions I've gotten over the last 2 or 3 weeks. What do I have to do to get the loan forgiven? Well, the amount of the loan proceeds have to be spent on the following 4 things. Payroll costs, obviously, interest, but not principal, on mortgage debt, rent, and utility payments. And then they've layered on another limitation on this. However, 75% of the forgiven amount that's calculated has to be for payroll. It has to be for payroll. Said in another way, not more than 25% of the forgiven amount can be for interest, rent, and utility payments. So there's some calculation that has to be done here to determine where you're going to go on how much your loan is forgiven and calculating where you spend the money over this 8 weeks. Again, there's planning involved. You can engineer this to try and get the maximum amount of your loan forgiven. And let me use a very, very simple example. There are very complex examples in the Q&As that we've gotten over the last 2 weeks, but here's a very simple example. You had 100 employees at this quarter a year ago. You have 50 employees now during this 8-week measurement period. You get 50% forgiven. Your number of employees have decreased by 50%, but you've retained 50%. 50% is forgiven. And again, the amounts forgiven are not taxable. That's not normal. Normally, cancellation and indebtedness, if you're not in bankruptcy, is taxable. These amounts that are forgiven are not taxable because it's in the CARES Act. It's in the law. Funding. Well, I've been asked this question by others, not by Tom, but by others. Why are we still talking about the PPP program? We heard funding just ran out yesterday on April 16th. Well, so many of these provisions are still ongoing, such as how to compute your debt forgiveness, right? That goes through June 30th, that computation. And as you've read in the paper, the Democrats and Republicans, the House has put forth a measure proposing $250 billion in addition to raise the amount of money available under this provision. So stay tuned. There will be more stimulus coming, and this provision in the CARES Act is still very, very relevant. Now, the Democrats, they couldn't agree on come to an agreement last night. The Democrats party and Nancy Pelosi are pushing for other things, which are great, and you'll read them here. I would expect that they will come to an agreement very shortly, and this will restart itself sometime in the near future. I talked about the second loan program, the Economic Injury Disaster Loan Program, or EIDL, as you may hear me call it. And since we've been dealing with these terms for 3 weeks now, it's become second nature to me to use EIDL. These are working capital loans up to $2 million for up to 30 years. It's a $10 billion program, not a $349 billion program as PPP was. Much smaller program. It's also run out of money, by the way, this week. But here are the terms of that loan. And it's much easier to get. This is why this is attractive. Fixed interest rate of 3.75% for businesses and 2.75% for nonprofits. For loans $200,000 or less, business owners are not required to personally guarantee the loan. You're not required to have been in business at least a full year, but you had to have been in business on January 31st, 2020. You do not need to show you're unable to obtain credit elsewhere. And if you elected also to participate in the payroll protection program, you can, but the proceeds from the two loans must be used to pay different expenses. For example, one loan, the PPP, could be used for your payroll to maximize the amount that you're subject to forgiveness on, and this program could pay for your rent. That's great, but what else does this program have to provide? Well, let's talk about who's eligible first, and then the $64,000 question about why this is really cool is coming up in the future slide. Eligible sole proprietors, independent contractors, again, the 500 employee rule. That's not a simple headcount rule, as I explained, and certain cooperatives and ESOPs, etc. How do you apply? I went on the website myself. I worked through the application process. It took literally 10 minutes. Like I said, you don't need to go to a bank. You're going directly to the SBA. You're going to this website. You're clicking on the website, and you're immediately into it. You are self-certifying the answers, and you're done in 10 minutes. If you get the loan, you do not have to accept the loan, and again, you self-certify. Let's talk about loan forgiveness. Does this program also have loan forgiveness? This is the catch that I mentioned 2 slides ago that's important. You can get up to a $10,000 cash advance that can be forgiven. Loan forgiveness on $10,000 on this smaller loan. And it's supposed to be funded within 3 days after the SBA received the application. And there's a caveat to be coming later on. And when they started to run out of money, they changed the terms on this. But as the law is written, $10,000 can be forgiven, 3 days to receive it. You self-certify, you don't have to pay it back. Similar to the payroll protection program, it's non-taxable. Will the SBA run out of money? Well, it has. Now, I wrote this on April 10th. It reported funding had already been reduced on the $200,000 loans down to $15,000 per business as they started to run out of money. And those $10,000 emergency grants or loans that were forgiven were being capped at $1,000 per employee. So if you only had 2 employees in your business, you could only get an emergency grant of $2,000. Employee retention credits. This is another one that other people think is I've seen as the most, what they think is one of the most important aspects of this, because again, you have control. You don't have to apply, you have to control over the benefits of this credit. You yourself do. And what is it? It's a 50% credit up to the first 10,000 of wages per employee between March 12th and January 1, 2021. So between now and the rest of the end of the year, you can take a 50% credit up to $10,000 in wages per employee. Do the math, that's a $5,000 credit. You take it on your quarterly payroll tax returns. That's money that you immediately credit on your payroll tax returns, and that's money in your pocket. You're just taking a credit and not paying the government. Now, this goes quarter by quarter on payroll tax returns starting in the second quarter. What if you're limited to, you can only take $4,000 on a particular employee in a quarter, and the limitation annually is $5,000. You get to carry that extra $1,000 over to the subsequent quarter, so from the second quarter to the third quarter. So you get your full $5,000. It may not all come in one quarter. If you can't recover all the money that you're owed through payroll tax returns, through limitations in the returns, there's a new form, a new IRS form, Form 7200, that you can apply to the IRS. You can submit the form and get a refund, a cash refund that way. Who's eligible for this retention credit? Well, if you carried on a trade or business in 2020 and satisfy one of two things. Your business operations were fully or partially suspended due to the COVID-19 breakout, or year over year, your reduction in gross receipts is at least 50% until gross receipts exceed 80% year over year. Now, if you have more than 100 employees, only wages for employees that are not currently providing services are eligible for the credit. Only wages for employees who are not currently providing services for the employer are eligible. For less than 100 employees, qualified wages include those of everyone. Again, if you're receiving a loan, well, not again, this is the first time I'm saying this one. Employees receiving a loan under the SBA Paycheck Protection Program, the PPP, they're not eligible for this credit. So you'll only get one or the other. You don't get both. If you take a PPP loan, you cannot take this credit. Deferral of payroll tax credit taxes. This is the second payroll tax provision in the law, and you can now delay, in addition to the credit, which is a permanent cash credit, you can also delay your payroll tax credits. The employer share of it, which is 6.2%. Those accountants online will recognize that number, 6.2% portion of the FICA, the employer FICA expense, and you can defer those payments on your payroll tax returns, 50% of it to December 31st, 2021, so more than a year and a half from now, and the other 50% to December 31st, 2022. It's a very long deferral of the amount of money you would owe on those taxes. And who's eligible for it? All businesses, self-employed individuals are eligible. However, if you received a loan under the PPP and your indebtedness was forgiven, so you got the loan and your indebtedness is forgiven, you're not eligible for this payroll tax deferral. Let's talk about retirement accounts. There have been a lot of articles and discussions and webinars just on this point. I'll go over it very quickly. The highlights for you. If you'd otherwise required to take a required minimum distribution, an RMD, from a retirement plan in 2020, that's waived for this year. You don't need to take a distribution. Now, there are some more details to this we want to talk about, different fact situations that could apply to you. For individuals that turned 70.5 last year and chose to defer their first payment to April 1st, which was the old rule, you're no longer required to take that payment this year under this law, which went into effect before April 1st. So hopefully you caught that. But what if you already took your 2020 distribution or 20 this year? If you're not dealing with an inherited retirement plan, and if fewer than 60 days have passed since the distribution, you can roll back the distribution, put it back in the plan, and it's as if you did not take your RMD. Okay? This rollover option allows you to reverse the distribution and proceed as though you never received it. What if it came from an inherited IRA? Unfortunately, you're out of luck. Inherited IRAs have RMDs that start right when you inherit the plan. You don't have to be 70 and a half or 72. It's right when you inherit the plan, the RMD starts. And if you already received it, then you're stuck and you can't do the rollback. Early withdrawals. Will there be a penalty? For individuals qualifying for corona-related distributions, and it's coming in that is a defined term. I'll go over in a minute. The 10% early withdrawal penalty is waived for distributions up to $100,000 in 2020. And the taxable income from those distributions, instead of being included in the